Assalamu alaikum friends. Welcome to SPR revision series for September 2021, and today we are going to cover a standard which is not there in your financial reporting. This is a new standard and this is already covered in your SBR. So that means there is a very high chance of you getting IFRS 2 for your SBR exam, because usually SBR exam test on those standard which is not asked in financial reporting in depth, and this is totally a new standard. Okay, so that means you have to know certain new things you will be discovering under this one which you have never went before. That's why I will be going a little slow in this standard. So share based payment, okay, that means you are making a payment other than cash. Okay, so overview. Okay, what is the scope of IFRS 2, what is it covering and all. Then two terms that you have to know: grant date and vesting date. Okay, for IFRS 2 you need to know these two dates. These two dates are different and you need to know them. Why it's important? Recognizing the transaction. How do you recognize such transaction? Then equity settled share based payment and cash settled share based payment. And for equity settled share based payment, we are going to have some modifications and cancellations also. Okay, so let's start with the overview. IFRS 2. Okay, this applies where an entity receives goods or services in exchange for shares or share options or cash that is based on a share price. So that means if entity is receiving a good, what happens in a normal condition? If they are buying a good, if entity buys a good, buys something, they pay in cash. Now or later, but they pay in cash, right? But in this case, they are not paying in cash. They are either paying in shares or share option or cash, but that cash is based on a share price. Same for services also. So that services is usually the employee services. Employee has worked in your organization for n number of years, and for that now you are paying back. You're compensating the employees, but not in cash, not in basic salary. Either you are giving the shares in your company to them, or you are giving them share options, or you are giving them cash that is based on a share price. So these are like some incentives that you are giving to employees. So for you, for the entity, these are expenses that you are incurring. Why? Because you are receiving services from the employee. You are receiving goods, okay? Goods or service for both. Other than cash, if you are receiving anything, if you are making a payment in anything else. So it's a share-based payment. That means you are paying in shares, okay? And that share could be in any type. Directly you are paying shares, or you are paying as an option, share option, or you are paying cash but based on a share price. So everything is about share, okay? So this diagram, this arrow, just see the arrow. This will help you to understand this better. Entity is giving share options or cash based on share price, and supplier or the employee is giving good or services. For example, you are taking a good from supplier, okay, or the services from the employee. So it's not only for the employee, this can also be applicable for supplier also, because from supplier you are receiving goods, okay. So the two dates that you have to know before I actually start with IFRS 2. One is grant date, one is vesting date. What is grant date? The date a share-based payment transaction is entered into. That means this is the date that you have decided that you are going to go for a share-based payment. That is known as grant date. The first time you have decided, that is known as grant date. And vesting date is what? The date on which cash or equity instruments can be received by the other party to the agreement. That means vesting date is the date when the other party to whom you have promised to give them share or share options or cash based on a share price, now they are receiving it. Now they will receive it that day. If they are taking a share option, that day they will exercise share options and they will receive the share. If they are taking share, that day they will receive share. If they are being paid cash that is based on a share price, that day they will receive on the day of the vesting date. Grant date and vesting date are not the same. Okay. Grant date, obviously grant date comes first and then only the vesting date. Vesting date will always be after the grant date. Okay. And there are some conditions also: vesting conditions, market performance conditions, and all those things is there in your textbook. So I would request you to please go through your textbook for IFRS 2, especially because you don't have this knowledge from your earlier studies. That's why you need to know everything about IFRS 2. In and out. Okay? And don't worry, it's not at all tough. It is only that the payment is now in share. That's it, not normally in cash. So how do you recognize this transaction? Okay, it is an expense. For the entity, it's an expense. We are paying shares, you are paying share option to your employees or supplier, it's an expense. Normally, if you would have paid in cash, salary to your employees in cash, it would be an expense for you, right? Same way, this is also an expense. But this immediately you cannot recognize it in a single period. You are recognizing this expense over the vesting period. Vesting period could be 3 years, 4 years, 5 years. They will give you the date. They will tell you what is the vesting period. Let's say where the vesting period is 3 years. So that expense from that share based payment, you will recognize it over 3 years, not in a single year. Okay. Based on the number of share based payments expected to vest, yes. If there are no vesting conditions, remember, then transaction is accounted for immediately. Okay. If there are no vesting conditions attached, that means employee has to be there for 2 years before they can receive the shares, or any condition is not there like that, then how do you recognize this transaction? Immediately. How normally you recognize expense, when you pay something in cash? Immediately. So if no vesting conditions, immediately you recognize. Because if no vesting conditions, how will you recognize it over a vesting period? Vesting condition is only not there, so you recognize it immediately. Okay, so this is the diagram. You see the grant date, year 1, year 2, year 3. So that year 3, the final, the end year, that is known as vesting date. That day only, if any option is given, it will be exercised or it will not be exercised. That day only, if share has to be given, shares will be given. That day only, if cash is to be given based on a share price, will be given on the day of the vesting, that is year 3. So over this 3 years, you are recognizing in the profit and loss as an expense. Okay, that expense only we are working out, that only we have to find out. Okay, so there are two types of share based payment that you can make. One is known as equity settled, the other one is cash settled. First, let us understand equity settled in depth. Okay, once you have understood equity settled, understanding cash settled is easier. Okay, because most of your questions are in under equity settled, because more questions can be asked also under this rather than cash. But cash settled question also has come in your past paper. Okay, so equity settled means you are settling in equity, you are settling in share. It's easy, right? It could be shares or share options. When it comes to cash, the word cash means you are settling it in cash. Cash paid based on a share price. Remember, you can pay to your employees or your supplier for the goods and services that you are receiving in 3 ways: share, share option, and cash based on share price. So share and share option are under equity settled, and that cash that you are paying based on share price falls under cash settled. Now you're understanding. So these are the two differences. From your exam kit, you can do garden and Mage, these two questions. Okay, garden I think I have completed. It's there on my SBR revision playlist. You can go out and check it out. Magi, I am not sure whether, I don't think I've completed it, but you can do it. Okay, and you must attempt all the questions for FRS 2. Now, so let us go through equity settled share based payment first, and then I will touch upon cash settled, because cash settled is only a small part that I can cover at the end, but equity settled is long. There we have modification, there we have cancellations. Okay, because anyway, calculating cash is very easy based on a share price, but calculating equity is a bit tough. You need a working there. So how do you find the value of this? How do you decide that expense? Remember, you have to put a value to this, the shares that you are giving, the share options that you are giving. Otherwise, how will you recognize expense, right? That's why you need to value this. How do you value this? You have to follow a diagram. Okay, one by one it will come, one box will come at a time. So first you need to ask this question. There are certain questions that you need to ask. Is the transaction with employees or others providing similar services? That means, are anyone providing the similar services that you are doing in your entity? For example, the share option that you are giving to your employees, are any other organization giving the similar, so that you can take their price? You can compare the price and take the price to find the value, the value that they are giving. If yes, then measure at the fair value of the equity instruments granted at the grant date. So you have to measure it at fair value. At which date? At the grant date of that equity instruments. It is equity instruments only. Everything will be equity instruments now. Share options. Okay, equity instruments means share or share options. If you want to find the fair value of the share or share options, look at the grant date. At the grant date, what is the value? Okay, and the good thing is about IFRS 2 is calculation. The figure will be given to you. You only have to know which fair value you have to take, whether the grant date or whether the vesting date. So here at the grant date. If no, okay, if no, ask another question. Can the fair value of goods and services received be measured reliably? Can you measure it? The fair value of goods and services that you are receiving. Here also that yes comes. Okay, if it's a yes, okay, then measure at fair value of goods and services received at the date they were received. So when you have to take the fair value of that good and services that you have received, that means services means the employee services that they are giving goods from the supplier at the date that they were received. Check the date that you have received it. At that date, whatever the fair value, you have to take that fair value. If no, if you cannot measure reliably the fair value of goods and services, then take the fair value at the grant date. Same like the first one. If you cannot measure reliably, at the grant date. If you can measure reliably, at the date they were received, take that fair value. Okay, so these are the questions that you need to ask and solve. Next, so this should be recognized in profit or loss. That means this expense, this equity settled share based payment, there will be an expense from this that should be recognized in profit and loss over the vesting period. If vesting period is for 3 years, over 3 years, 5 years, divide by 5 years, like that. Okay, it depends on the based on number of shares or options that are expected to vest. Let's say you are expecting that this many options will be exercised, so based on that you will recognize. Okay, now accounting entry is very important. Okay, most of the time they ask for the accounting entry. So what is accounting entry for this? At each reporting date, okay, you debit profit and loss, you credit equity because it's an expense for you. And where will it be credited from? To equity, because it's an equity settled share based payment. Shares or share option, that's why you have to credit equity. Okay, now under equity settled share based payment also it could be modified. The terms could be modified under this, right? Modification. If modification happens, what do you do? Remember, this modification and cancellation we are studying only under equity settled share based payment. We don't want under cash settled share based payment, okay? Because cash price is based on a share price, so usually that is not modified or cancelled. But equity settled share based payment is not like that. Okay, so let's say entity continues to recognize if it's modified. Okay, that means some changes has taken place. Then entity has to recognize the grant date fair value of the equity instruments in profit or loss. Continue to recognize. There is no change in that. Earlier also they were taking at the grant date only the fair value, okay, of the equity instrument. That means of shares or share option, whatever the fair value of the grant date, that only you are taking as an expense in profit or loss, with or without modification. The changes comes here in the second point. Entity now also has to recognize an extra expense because of this modification. Why? Because there's a difference in the fair value of the new arrangement versus the original arrangement. That means before this modification. So with the modification, without the modification, the fair value is different. That's why there will be an extra expense that you have to recognize. Okay. So the incremental fair value between the date of the change and the vesting date. Date of the change will be obviously before the vesting date only, right? Let's say your vesting date is vesting period is for 3 years, right? So 1 year it went normally, but in the second year you modified. So from for the second year and the third year, these 2 years, you will be accounting it under modification. Extra expense you have to recognize. Okay, now let us go to the cancellation. Cancellation or settlement, that means you are settling the share option scheme. That means you are paying immediately before the vesting date, you are paying them in shares or share option you are giving your employees. or you're canceling, then what happens? Canceling before the vesting date, then what happens? Then how do you recognize? Okay, then immediately you have to recognize that amount. Earlier you were going to recognize it over a vesting period, right? At the end of the vesting date only, entirely everything will be paid off. Now immediately you recognize it. Okay, which is known as an acceleration of vesting. That means you are speeding up. Before the vesting only you are paying recognizing immediately the whole amount. Otherwise, normal time what happens if you didn't cancel it, normally it will be recognized over the vesting period only. That services. But now immediately in the single period. Next, any payment made to employee up to the fair value of equity instruments. See, every time here we will be talking about equity instruments. Equity instruments means shares or share option, both it includes, okay? So if you are making any payment to the employees up to the fair value of equity instruments at cancellation, at the date of cancellation, remember, it is accounted for as a deduction from equity. Why? Because from equity only you are paying, no? That share you are paying from equity, that share option you are paying to the employee will go from where? Equity. So it will be cut off from your equity. Up to that fair value of equity instrument, let's say the fair value of your equity instruments, fair value of your share option is 10 million and you are paying employee 10 million. So the whole 10 million will be deducted from equity. Okay, but you know that reality does not work like that. We normally will be paying more, right? More than the fair value of that shares or share option. Very unlikely, right, that you are going to pay exactly the same amount. Not always. So what happens? How do you deal with that excess amount? So any payment made to employees in excess of the fair value of equity instruments, that means beyond the fair value of the share options or shares you are paying to your employees, then that expense will be recognized in profit and loss. That also will be an additional expense. This comes under cancellation. Okay. Remember, for cancellation, on that date, cancellation date, whatever the fair value of that share option or shares, you have to pay to your employee. Okay. That is the meaning of cancellation. That means you will not hold it up to the vesting date. You will not let it be there for 3 years or 4 years before you can actually exercise the option, before you can actually take the share. Before that only you are cancelling. So you have to pay your employee. You have to compensate them for this cancellation. That's the reason it's an expense. Now, finally, we are going to cash settle. So that's it for equity settled, right? I hope you have understood equity settled very well. Now let us go to the cash settled share-based payment. So for cash settled, okay, this is often referred to as another term which is known as share appreciation right. Why? Because cash you are paying on share price only. So it is known as share appreciation right, SAR. Remember, whenever SAR or share appreciation right, they have mentioned in your requirement. They have talked about this in your scenario, the case study that is given to you. That means they are referring indirectly, they are referring to cash settled share based payment. Okay? Because this term does not come under equity settled share based payment. So here, there are two differences between equity settled share based payment and cash settled share based payment. That is SAR. What are the two differences? Number one, until the settlement date, expenses valued using the fair value of SAR at the reporting date. That means until you didn't settle in cash, until that day, okay, the expense, it will be an expense only whether you are paying in equity or cash, does not matter. It will be expense for the entity. So that expense only you are valuing now. What is the actual amount of expense? So that expense will be valued using the fair value of SAR at the reporting date. But what happens for the equity settled share based payment? You are taking at the grant date, fair value of the grant date. Here, you are taking the fair value of the SAR. You cannot say equity instrument. Fair value of SAR, share appreciation right, at the reporting date, not at the grant date. That's the difference. Okay. Second difference is accounting entry. Accounting entry is different. Here, profit and loss is same. Whether it is cash settled or equity settled, both will be debit profit and loss because it's an expense in both the cases. But where do you credit? That's the difference. You credit it under liability. Yes, for cash settled, you credit for liability. For equity settled, credit equity. Because it's a liability for you. You have to pay. So credit liability. Okay. So that's it for FRS 2 that you need to know. And next standard, very important standard, right? Which is IFRS 3, which is your business combination. Okay, also important, must standard for your group accounting, which comes under your question number 1 for 30 marks. Okay. Here we are going to go through all the principles. How do you measure NCI, fair value of net assets, goodwill, impairment of goodwill, everything relating to consolidation, business combination, and everything. So till then, thanks for watching and see you in the next video.